Have you ever caught yourself lying awake at night, running numbers in your head, wondering whether you're ahead or behind everyone else financially? Maybe you're scrolling through your feed, watching someone post about a brand new car or a trip overseas, asking yourself how they're pulling it off on what you assume is a similar salary. Well, today I'm going to lay out the actual financial reality of the average American, and some of these numbers are going to catch you completely off guard. Some will give you genuine relief about where you stand, others are going to be a real wake-up call. Either way, by the time we're done, you'll have a clear, honest picture of exactly how you compare to everyone else in this country when it comes to money. My name is Nick, and I break down money, personal finance, and wealth building in a way that actually makes sense for real people. If getting your finances on track and pulling ahead of the pack is something you genuinely care about, subscribe to the channel and hit the like button if this information hits home for you. Before we get into the numbers, let me ask you something. When you picture the average person's financial situation, what do you actually see? Someone who has it together, building wealth steadily, and working toward a comfortable retirement? Or someone who's basically winging it paycheck to paycheck and just hoping things work out? The truth is, most of us have no real idea what financially normal actually looks like. We make assumptions based on what we see around us, but the reality almost always looks different from what we imagine. And here's what makes this topic genuinely worth your time. Understanding these numbers isn't just about satisfying a curiosity itch. It's about giving you real, usable information to make smarter decisions with your own money. Think about it this way. If you were trying to get in better physical shape, wouldn't you want to know what the average person weighs or how much they actually exercise? If you were trying to raise your grades, wouldn't it help to know where you stand relative to everyone else? Money works exactly the same way. When you know where you actually land, you can make more deliberate choices about how you spend, save, and invest going forward. So let's start with something that touches every single working person in this country: income. When your paycheck hits every 2 weeks, are you bringing home more or less than the typical American worker? According to the most recent data from the Bureau of Labor Statistics, the median weekly earnings for a full-time worker came in at just over $1,000. That translates to roughly $52,000 a year before taxes. Let me sharpen that number a bit. We're talking individual income here, not household income, which would factor in a working spouse or other family members contributing to the household. And when we say median, that means exactly half of all full-time workers earn above this amount and half earn below it. It's the dead center of the pack. If you're pulling in around $26 an hour, you're sitting right alongside the average full-time American worker. But here's where it gets more sobering. That $52,000 is before taxes take their share. After federal income tax, state taxes, Social Security, and Medicare, that figure shrinks pretty fast. Depending on where you live, you're likely taking home somewhere between $35,000 and $40,000 a year. Suddenly, that paycheck doesn't stretch nearly as far as it looked on paper. But income is only one piece of the puzzle. What really matters is what people actually do with that money once it lands in their hands, and this is where things get both fascinating and honestly a little concerning. Let's talk about retirement savings, because this is where a lot of people are heading toward a genuinely harsh reality. According to the Federal Reserve's most recent survey, the median amount Americans have saved for retirement is $65,000. Before you decide how to feel about that number, keep in mind it includes people of all ages who actually have retirement accounts to begin with. Here's the part that should stop you cold. About 25% of Americans have no retirement account whatsoever. Zero saved. Not a single dollar set aside for the day they can no longer work. 1 out of every 4 people you pass on the street is counting entirely on Social Security when retirement arrives, assuming the program is still intact by then. For the people who do have something saved, the numbers shift dramatically by age group, and some of them are hard to look at. People under 25 have a median retirement balance of less than $2,000. To be fair, if you're 23 and just getting your career off the ground, $2,000 isn't a disaster. But it does underscore how critical it is to start building that habit as early as possible. The 25 to 34 age group does a little better, landing at a median balance of around $14,000. But even that feels thin when you consider these are people who have been in the workforce for several years and should be gaining real financial momentum. By the time we reach the 65 and older crowd, the median retirement balance climbs to around $88,000. That might sound meaningful until you put it in real-world context. If you retire with $88,000 and apply the traditional 4% withdrawal rule, you're pulling out roughly $3,500 per year from your retirement accounts. That's less than $300 per month. Sit with that for a second. Could you actually live on $300 a month in retirement? Even if you own your home outright with zero mortgage payment, $300 wouldn't come close to covering groceries, utilities, healthcare, and basic daily living. This is exactly why these statistics matter. If you're in your 20s, 30s, or 40s staring at these retirement numbers, you should be having a completely honest conversation with yourself right now about whether you're saving enough, because the average American clearly isn't. Since so many people are banking on Social Security as a primary source of retirement income, let's look at what that actually pays. The Social Security Administration reports the average monthly benefit runs around $1,550. That's roughly $18,600 a year. $18,000 might feel workable on the surface, especially if you don't have a mortgage hanging over your head, but keep in mind this is the average benefit. If you had years where you weren't working or periods where your earnings were low, your benefit could come in significantly below that figure. And if your earning history reflects modest wages across your working years, you might be looking at a monthly check that barely covers the essentials. On the flip side, some people take a completely different strategic approach. They build their entire retirement plan around the assumption that Social Security won't exist for them at all, treating any benefit they eventually receive as a bonus they didn't count on. That might sound overly cautious, but given the long-term funding realities facing the program, it's probably not the worst mindset to bring into your planning. Let's shift gears and get into something that hits your daily life right now: spending. How much does the typical American household actually burn through each month? According to the Bureau of Labor Statistics, American households spend an average of about $5,577 per month. Over a full year, that adds up to roughly $67,000 in total spending. Think about what that actually means in practice. If the average household is spending $67,000 a year, they need to bring home at least that much just to stay even. And we're talking take-home pay here, not gross income. So if you want any money left over to build savings, investments, or any kind of real financial future, your household needs to be clearing well above $67,000 after taxes. That monthly spending breaks down into some fairly predictable categories, but the actual dollar amounts might raise an eyebrow. The biggest slice goes to housing, which won't surprise anyone who's ever written a rent check or a mortgage payment. The average household spends about $1,885 per month on housing, covering rent or mortgage, property taxes, insurance, utilities, and upkeep. That's over $22,000 per year just to keep a roof over your head. And if you're anywhere near a major metro area, you're probably reading that number and smiling, because it likely sounds low compared to what you're actually paying. In markets like San Francisco or New York, $1,800 might not even get you a decent one-bedroom apartment. Food comes in second, with the average household spending about $691 per month across groceries and dining out combined, over $8,000 a year just to keep everyone fed. If your household is consistently coming in under $700 a month on food, you're genuinely doing something right, or you've mastered the discipline of cooking at home on a consistent basis. Transportation consumes another $913 per month, covering car payments, insurance, fuel, maintenance, and any public transit costs. Nearly $11,000 a year just to move from one place to another. This is exactly why so many financial advisors push the guideline that your housing and transportation costs combined should never exceed 50% of your income. Stack that $1,885 in housing against $913 in transportation, and you're already sitting at $2,798 per month before a single other expense enters the picture. Now let's talk about something that quietly shapes almost every major financial decision you'll make: your credit score. Most people know they're supposed to care about it, but a lot of them have no real idea how their number compares to everyone else. According to Experian, the average FICO score in America sits at 750, which is actually a reasonably solid number. FICO scores range from 300 to 850, so 715 puts the average American squarely in the good credit territory. What's worth noting about that figure is that it suggests a lot of people are doing at least some things right, generally paying bills on time and keeping debt levels at manageable levels. But don't let a 715 national average give you the impression that everyone has their credit situation figured out. There are still plenty of people walking around with scores in the 500s and 600s, genuinely puzzled about why they can't qualify for a reasonable interest rate on anything. Your credit score touches more of your financial life than most people recognize. It drives your mortgage rate, your car loan terms, and in some cases, whether an employer will even move forward with your application. The good news is that a strong credit score doesn't require any special financial intelligence. Pay your bills on time, don't max out your cards, and resist the urge to open a new credit account every time a retailer dangles a 10% discount in your face. It really is that straightforward, and yet a meaningful portion of the population still manages to work against their own score. Speaking of credit, let's step into the conversation most people would rather avoid. Credit card debt. This is where the picture gets uncomfortable fast. The average American household is carrying over $9,000 in credit card debt. Not a mortgage on a home building equity over time, not a car loan on a vehicle getting you to work each day. $9,000 sitting on stuff that's probably collecting dust in a closet somewhere or has already been tossed out completely. What compounds the damage is the interest rate stacked on top of all of it. We're talking 15%, 20%, sometimes well north of 25%. If you're carrying $9,000 at 20% interest, you're burning through $1,800 every single year in interest payments alone. Money that isn't building a single thing for your future, it's simply making credit card companies wealthier at your expense. And here's what really bothers me about credit card debt at this scale. The overwhelming majority of it wasn't accumulated through genuine emergencies or unavoidable hardship. Sure, that happens, and it's a legitimate use case. But let's be honest about where most of it actually came from. Clothes that are already out of rotation, electronics that have since been replaced, dinners out that were forgotten the next morning, and online shopping at midnight that felt completely justified in the moment. The fix is simple enough to explain even if it's harder to actually do. Pay your balance off in full every single month. If you can't pay cash for something, don't put it on the card unless it's a genuine emergency. And if you're already sitting on a balance, make eliminating it your top financial priority, ahead of everything else, including investing for retirement. There's no logic in chasing a 7% return in the market while paying 20% interest on credit card debt at the same time. Now let's look at the number that probably tells the most complete story of someone's overall financial health: net worth. Net worth is straightforward: total up everything you own, subtract everything you owe. Your home, your vehicles, your bank accounts, your retirement accounts, any other assets, minus your mortgage balance, credit card debt, student loans, and any other outstanding obligations. What remains is your net worth. According to the Federal Reserve, the median net worth for American households is about $122,000. But like nearly every other figure in this conversation, it shifts dramatically by age group, and some of those breakdowns are genuinely eye-opening. If you're under 35, the median net worth is less than $14,000. If you're 25 and just getting your footing, that isn't necessarily a red flag. But if you're approaching 34 and that's still your number, it's time for an honest, unfiltered conversation with yourself about the direction your financial life is actually heading. The 35 to 44 group improves to a median net worth of $91,000. The 45 to 54 crowd reaches $168,000. People in the 55 to 64 range hit $212,000, and those between 65 and 74 land at $266,000. What I find genuinely encouraging about these benchmarks is that they're within reach for most people with a reasonable income and some consistent basic financial discipline. You don't need to be a market genius or launch the next major company. You just need to earn more than you spend and put the difference somewhere it can grow over time. But there's another dimension to this picture that we need to address directly. Savings rates. How much of their income is the average American actually setting aside each month? The Bureau of Economic Analysis shows Americans are saving about 6% of their after-tax income. Just 6%. That might not sound catastrophic on the surface, but think through what it actually means in real life. If 6% of your income is going to savings, and a portion of that has to cover shorter-term goals like a vehicle purchase or a home down payment, there isn't much left for any serious long-term wealth building. The average down payment on a home runs about $62,000. A kitchen renovation averages around $26,000. A new car is coming in at over $47,000. If you're setting aside only 6% of your income and trying to fund all of those goals at the same time, how much is actually making it into your retirement accounts each year? Most financial planners recommend saving a minimum of 10 to 15% of your income specifically for retirement, and that's on top of whatever you're setting aside for shorter-term needs. If retiring before 70 is part of your plan, those percentages probably need to go even higher. This leads us into something that might actually surprise you. Average retirement age. When do most Americans actually stop working? If you guess 65, you're close, but not quite right. Recent data puts the average retirement age at 61. That might sound appealing at first. Who wouldn't want to be done at 61? But here's the catch. Full Social Security benefits don't kick in until age 67 for most people. So if you're walking out the door at 61, you're staring down 6 years of bridging that financial gap entirely on your own. And if your retirement savings look anything like those median numbers we already walked through, those 6 years could get genuinely uncomfortable. Let's frame this a different way. If you start working at 22 and retire at 61, you've put in 39 years in the workforce. Nearly 4 decades of early mornings, commutes, performance reviews, meetings, and grinding through whatever your career demands. After all of that, you retire with around $88,000, which, as we've already established, produces roughly $300 a month in withdrawals. Does that feel like a fair return on 39 years of work? Because from where I'm standing, it really doesn't. But here's the layer that adds even more urgency to all of this. The Social Security Administration reports that someone reaching age 65 today can expect to live another 19 to 21 years. So if you retire at 61, you could be looking at 25 years or more of retirement that needs to be funded. 25 years. That's longer than most people's entire careers up to that point. And here's the question that deserves a straight answer. Out of those 25 years, How many are you actually going to be healthy enough to live the way you've always imagined? At 61, there's a solid chance you're still in good shape. But what does that picture look like at 71 or 81? The things you can do at 65 may not be available to you at 75. Time has a way of making that decision for you. This is exactly why understanding these financial benchmarks goes well beyond satisfying curiosity. It's about recognizing that the path most Americans are currently walking isn't leading anywhere most of them would choose if they could see it clearly. When the typical person retires with less than $90,000 saved and is carrying $9,000 in credit card debt, something in the habits and in the approach is clearly not working. But here's the part I actually want you to hold on to, because this is why I laid all of these numbers out in the first place. Once you see what average looks like, it becomes very clear how to do better than it. And doing better than average doesn't require a secret formula or financial knowledge that's only available to wealthy people. If you're consistently saving more than 6% of your income, you're already ahead of most people. If you're carrying zero credit card debt, you're way further along than you probably realize. If you understand what you're invested in and you're actively contributing to retirement accounts on a regular schedule, you're not just ahead, you're playing a fundamentally different game. The reality is that most of these averages aren't that hard to beat with some real intentionality and consistency over time. You don't need a six-figure salary or a family inheritance to pull it off. You just need to be a little more deliberate about your money than the average person, and honestly, that bar isn't set particularly high. Think about it this way. If the average household is spending $5,577 a month, and you figure out how to live comfortably on $4,500, you've just freed up $12,000 a year to redirect into savings and investments. Do that consistently over a few decades, and you will be in a completely different financial position than most of your peers. The same compounding logic applies across every single category we've talked about today. Beat the average by a meaningful margin in a few areas, and the cumulative effect over time is enormous. Earn a bit more than $52,000, save more than 6%, stay completely out of credit card debt, and invest consistently in low-cost index funds, and you will retire with dramatically more than $88,000 sitting in your accounts. What I find most revealing about all of these numbers is what they expose about the gap between what people say they want and what their actual daily behavior reflects. Everyone will tell you they want financial security. Everyone says they want to retire with dignity and options. Everyone says they're exhausted from worrying about money. But the average person's financial habits don't align with any of those stated goals. Part of the reason might be that most people genuinely have no idea what average actually looks like. They assume everyone around them has their financial act together, so they feel no real urgency to change anything in their own life. Or they know they should be doing better but have no clear starting point, or they've quietly convinced themselves it's already too late for it to matter. If you're watching this and some of these numbers landed a little too close to home, don't let that turn into paralysis. The fact that you're here at all, actively learning about your financial situation and trying to understand where you stand, already puts you ahead of a significant portion of the population. Most people never take the time to look honestly at these numbers or figure out what actually needs to change. Use these statistics as fuel, not as a reason to give up. If you're 35 with a net worth under $14,000, you're not doomed. You have a real gap to close, but you also have 30 or more years of runway ahead of you. And that is more than enough time to change the trajectory if you start moving in the right direction now. And if you're already outperforming these averages in certain areas, don't let that become a reason to coast. Maybe your credit is solid and you're completely free of credit card debt, but your retirement contributions are lagging behind where they should be. Maybe you're disciplined about saving, but all of it is sitting in a low-yield savings account instead of being invested somewhere it can actually compound meaningfully over time. The bottom line is this. These numbers should open your eyes, but they should also light a fire under you. When you know what normal looks like, You get to decide whether normal is where you want to end up or whether you want something genuinely better than that. Personally, I don't think retiring at 61 with $88,000 and hoping Social Security stays funded is what you've been grinding toward all these years. You deserve better than watching every dollar disappear before you have a chance to do anything meaningful with it. You deserve the kind of peace that comes from knowing your financial house is actually in order and your future is actually accounted for. These statistics show where the average American ends up. They do not have to be where you end up. Use them as a starting point, not as a destination. Because once you truly understand what most people are doing with their money, it becomes very clear what to do differently and what a different outcome actually looks like on the other side. That choice belongs entirely to you.